Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on the loonie, equities, and precious metals for the week. Colorado-based ZealLLC.com CEO Adam Hamilton examines a long-range forecast for gold and silver. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is CIBC Wood Gundy Vancouver investment advisor Ross Clark. Welcome back to This Week in Money, Ross.
And it's nice to be with you, Jim, as always. And this week, just a terrible week for those in Fort McMurray, and our prayers and thoughts are with all of those people.
And Ross, of course, the Canadian government says it'll match any donation you make to the Canadian Red Cross to help those people out. Taking a look at the economies on both sides of the border, the U.S. had softer than expected employment numbers, and that's never a good thing.
No, with that, initially the U.S. dollar sold off a bit. It came back towards the end of the day on Friday. But, the bigger impact here is that with the softer economy, it means that some of the hawkish statements that had come out from Fed governors in the last week, leading people to believe that the Fed might in June have a better chance of raising interest rates, well, this really softens that so that probability now is that you're clearly out into the fall at best before you would see a rise in U.S. rates. And we know what that means for the gold market. Gold market likes to hear that. It tacked on one of its better weeks, or I should say better conclusions to a week, getting back to where it was a week ago. It had broken out a week ago, pulled back to test that breakout, and then closed off this week up around $1,290, near some of the best levels we've seen in the last year and a half or so. Now, it's in our work, and we sent some research out to the listeners over the last week regarding this, that when the dollar or the gold market has had a rally of this extent, with the commitment of traders numbers being as excessive as they are, and the miners outpacing the bullion, etc., we really need to see that each one of those breakouts to new highs only comes back to kiss the breakout and doesn't start to violate it, because you'll end up with a fair amount of volatility and a lot of pressure once we start to take out support. So I recall back to the 1970s as we started to stair step up from $100 to $850. In that first year and a half or so of the move, each breakout only corrected back about half of the run, held above the highs, and I think we got up to about the $240 level before we had the first hard correction. So this time round, we've had a lot of trouble getting through the 1260 to 1270 range. We're now sitting above, and it will be very, very important, I think, that we now hold that 1260 to 70. It's where we've got some moving averages. I've got a 20-day moving average sitting around 1263, and it's coming up underneath us pretty quickly.
Is there a magic breakout point, say if it hits 1365, that all of a sudden people will feel it can do nothing but go up?
The psychological point is probably if you clear 1300 decisively, and, whether that's 1305, 1310, something along like that, those lines. The gold market does like to play around the round numbers, the hundreds, and my work, I've got two key resistance levels here. 13.25 is a speed line coming down from the all-time high, and my major one is up at 1440. And I've learned that stranger things can happen, the strangest things can happen, that if we were to pop through here, both of those are distinctly possible in the next month or so, but we're also, we take a look at the time frame of this rally, the time span. Depending upon whether you measure it from the middle of December or the 1st of January on when we were at 1160, we've rallied for either 18 or 20 weeks. And the longest rallies we've been having with high commitment of traders numbers like we have now have been 20 to 22 weeks before significant corrections. So this one's getting long in the tooth. It's got, I would say, at the most, another 2 to 3 weeks left in it. However, in silver and in gold, some of the best runs, the best price action happens in those last few days or last week in the move. So, I've been advising cautious for quite a few weeks here with, talking about support levels that were at 1210 and then 1220. And I think now, the investors should be looking at last week's lows as the critical ones. So for traders, I don't think you'd want to risk below the pullback that we had in the middle of last week.
What about the price of crude? It's been tickling $45 a barrel for some time now.
It peaked about a week ago, had a short sell-off to the 43.5 range, and we're back at 44.5. And it's looking like it's getting a little tired up in here, starting to get a bit of a rolling effect to it. And, we're thinking that if it breaks through 43.5, you're probably looking at something in the high 30s. You've had a mix of news. Uranium production is right back up to levels that it was back in 2011. I think we were talking about it being up over 3.5 million barrels a day. Again, on the other side of the coin, you've got Canadian production down because of what's happening in Fort Mac right now. But from a technical perspective, I think 43.5 is the level that we want to be watching in there. And the other item, that has historically moved with the oil market has been the Canadian dollar. And at the bottom in January, February, it was interesting that the dollar held extremely well when oil went down to retest its $26 low. And the Canadian dollar only gave back about a third of its first rally off the January low at that time. So it showed really good positive bias to it. This time round, Canadian dollar, after that 15 or 16 week rally, finally rolled over. We were at 80 cents on Monday, and by the end of the week, we'd given up 2 3/4 cents. So we've got an outside reversal week. New high above the previous week, a lower low, so it's a pretty significant reversal. And it's happening when the oil is just having some trouble at the top end. So this is kind of the reciprocal of what we saw at the bottoming action in January, February. Probably could be looking towards the same topping action right now. And the Canadian dollar, going to be looking for something in the 73 to 74 cent range as a realistic correction of the rally that we've had from the January bottom.
Ross, thanks a lot for chatting with us.
Pleasure to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. You can contact Ross at ross.clark@cibc.ca. Coming up, Zeal LLC CEO Adam Hamilton here on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Adam Hamilton, CEO of ZealLLC.com. Welcome to This Week in Money, Adam.
Thanks so much for having me, Jim. Great to see you.
Great times for gold and silver right now. Why the big push to gold and silver while the equity markets are falling down? Is that the biggest reason?
Absolutely, Jim. Gold has always been the leading alternative investment. It's one of those rare assets that moves counter to stock markets. So the reason gold got awoken from its long bear market and slumber earlier this year was because the stock markets were sliding, and that made people realize that, hey, we have our portfolios, heavily in stocks and bonds, nothing else. If stocks go down, if bonds go down, as rates rise, what are we going to do? Where are we going to get some return? Where are we going to protect our capital? And so people started buying gold again. On both the gold and silver fronts this year, there's been incredible buying from investors, and that's the key. Normal commodity gold and silver demand is pretty steady, pretty constant over the years. It doesn't change much. But investment demand's a wild card in both gold and silver. When investors get interested in the precious metals, their marginal buying, their additional demand just causes the prices to soar. And that's what we've seen in both gold and silver in 2016 so far. Huge buying on the investment front. Unfortunately, it's kind of hard to see this because gold and silver are pretty opaque markets in supply and demand terms. The best gold data fundamentally is published by the World Gold Council once per quarter. In the first quarter report by those guys isn't even out yet as of this week. The best fundamental data for silver is from the Silver Institute, and they only publish that once per year, that resolution is way too low for anybody trying to invest or speculate in the markets, obviously. But the one proxy I like to go to is the world-leading gold and silver ETFs, Jim, because they publish their holdings daily, how many ounces of gold they have, how many ounces of silver they have, and that's GLD and SLV, of course. And when their holdings rise, that means that stock market capital is flowing into gold or silver bullion. And when their holdings fall, stock market capital is flowing out. We've seen massive builds in GLD and SLV bullion inventories this year. That means investors are flocking back en masse. These builds have just been at record levels. Gold's build in February was around 108 tons GLD, and that was the biggest monthly increase in gold's bullion holdings in 7 years. In silver, SLV's holdings started shooting up in March. In January and February, investors weren't really playing in silver yet. But in March, they started buying SLV aggressively. And once again, SLV and GLD are proxies for investor interest. Since they're published daily, we can see them before the real supply and demand reports come out. That investor buying has been absolute key. And I think why silver lagged gold is because silver is kind of a gold sentiment gauge historically. When gold moves, when gold's running, when gold's in a bull market, people want to buy silver because it tends to leverage gold's upside. But when gold's down or falling or in a bear market, people don't want anything to do with silver. Silver's a volatile metal. It's a risky metal. It can move so big in just a short period of time that there's a lot of risk involved in it. So investors coming back is a huge deal, and that's what's driving these gold and silver bulls, Jim.
When you said silver's risky, does that mean when it does start to go up, it's more likely to jump at a bigger margin than gold does?
Absolutely. That's part of it, without a doubt. Silver tends to leverage gold's upside. You have a given move in gold, silver's probably going to be up 2 or 3 times that over the same span. And that rule, you can't get too hard and fast with that. If you look at any individual trading day, even a trading week, even a month sometimes, silver and gold aren't super correlated. But if you look over, decades or long periods of time, the correlation is very high. The main risk in silver is the extreme volatility. Now investors usually play gold and silver in physical bullion, which is what I recommend, or also the ETFs, which is an easy and efficient and cheap way to get that same kind of exposure in your portfolio today. But traditionally, people played gold and silver in futures, and obviously futures don't require you to have much cash on hand. They have relatively low margin requirements compared to the amount of gold and silver you can control. So when you have a metal like silver moving 3, 4, 5% a day, and you have 5% margin in your futures account, you can get wiped out by an adverse move. And so big volatility like in silver just makes silver exceptionally risky for speculators. But for investors, it's an incredible bet. As long as gold's in a bull market, and I think we just entered a new cyclical bull market here, and I think it's going to be a secular bull market for a lot of reasons. Silver is going to go much higher than gold over the whole span of this thing. It's really exciting.
Some people have said silver could be the metal of the future simply because so much of it is used for solar power, which is gaining in popularity.
That's really interesting. For years, the destructive nature of silver use has been a huge selling point for it. Gold, it's mined. People put it in vaults. A lot of it goes to jewelry, but a lot of it's vaulted, so the supply is essentially always there. But when you put silver in your solar panels or iPads or wherever, it's almost unrecoverable. I know there's some recycling firms that are trying, but usually it's non-economic to break down devices or electronics to get the gold and silver out of them, and so they're just thrown away in landfills around the world, buried. And so the amount of silver that's destructively used is really bullish for it because there's less above ground supply because of that. It's kind of consumed like crude oil more so than gold, which just kind of always exists except for, a few niche uses for gold. So yeah, that's definitely a huge bullish factor in silver's favor.
When people are looking at investing, would it be a good idea to buy an ounce or two of silver every month just because it's easy to do and affordable?
Oh, absolutely. That's a fantastic idea. I've been trading professionally for decades now, and timing the markets is exceptionally hard. You have an idea when things are relatively high or relatively low based on historical studies, based on everything that's happened that's come before you, but you never know exactly where top or bottom is. So it's always a probabilities game. There's high probability for success times to buy, high probability for success times to sell, but there's never a certainty. So if investors want to buy silver, they're better off not waiting for this low. That's one of the great, kind of failures people have at the end of bear markets. They tend to extrapolate the present into infinity, and that causes them to wait for this big washout. They're like, okay, if silver goes down 10 more percent, I'll buy. And once it goes down 10%, they'll be like, okay, another 10%. Everybody's still bearish. All these things are against silver. But the dollar cost averaging approach you're talking about, Jim, is fantastic, because if you buy a little bit of silver and gold each month, or whatever you want to buy, any kind of investment, you have a better chance of averaging in across a low period, buying at the lows and selling at the highs. And so I've always run our trades like that in my business and personally. We tend to average in, we tend to average out, just because you can't call exact bottoms and tops ever, and so there's no sense trying. And it really spreads your risk to buy over time gradually. It's a great strategy, without a doubt.
Do you have to look at the geopolitics of any area that mines silver? It seems to be it comes from places where things can become very unsettled very quickly.
Yeah, definitely. Silver is kind of unique in the sense that most of the silver production comes from non-primary silver mines. Most of it's a byproduct from base metals and gold. And so you kind of got to look at the big base metals and gold mines if you're looking for, kind of cues about the fundamental outlook for silver. So geopolitics is not an area I concentrate on particularly for silver, for big silver trends. When I'm looking at individual miners, absolutely, I want to see what jurisdiction they're in, what the government's doing, what the government's done in the past, how much hassles they've gotten from local, people around the mines. But as far as the whole silver supply, the big picture, I think it's pretty not very important, because silver comes from all over the world and it's mostly a byproduct. And these big base metals and gold mines are so important to the governments that host them. Usually they don't mess around with them enough to significantly curtail production.
What about technology? Mexico's been a traditional source of silver for 500 years, and I've heard mines that they thought were played out now are accessible because they have pumps that can take out the millions of gallons of water that flow into these deep mines.
Yeah, that's a huge trend. It's really interesting. There was one mine, I think it was in Mexico, or one company in Mexico, and they got their start actually mining a tailings pile. There was this huge tailings pile next to the city, and I can't remember the specifics, unfortunately. It's a fascinating story. And this company cash flowed a real mine by actually mining the tailings from a several hundred-year-old operation. And so Mexico has been a hotbed for gold and silver exploration in the past decade. There's so many old workings, and the best place to find gold or silver is someplace that's already been found. If you want to go out and do greenfields prospecting, it's really, really hard because it's a big world out there. It's hard to find signs of the minerals on the surface. There's so much ground to cover. But if you find old mine workings and can research and find out that they had significant production, odds are the miners of yore just barely scratch the surface with their technology. And so that's where today's companies, today's explorers go to find gold and silver, is past mined regions. And Mexico is like the epicenter of that for the entire world. Pretty fascinating stuff.
And on television, too, reality TV, we have Yukon Gold Rush. Families or small collections of workers looking for gold. And as you said, they go back to where people mined in the past, but we have better technology now.
Yeah, radically better. It's amazing what we can recover today. It's amazing the drilling they can do to find out where veins go underground. And they look for the source deposits now. If there's some kind of placer type deposit, a stream deposit, they'll go back and they'll try to find the source now. And usually they can find it. Might take a couple of years, but they'll find out where the gold and silver actually came from that was, dribbling into the rivers that people mine historically. So it's a great way to find the metals, without a doubt.
And of course, knowing about geographic trends helps too. Northern Ireland now has gold, and one of the reasons is a guy was looking at aerial photographs and noticed that a small stream was making some radical changes in direction. Well, that's because it was running into quartz, and quartz is associated with gold. So just knowing things like that.
That's a dream. I'd love to be involved with something like that. Find a, greenfield discovery just kind of through serendipity. I went to school in Boulder, Colorado, and my barber back then, Jim, he had a house up in Boulder Canyon. It's a mountain canyon right west of the city, and there's a river that goes through, Boulder Creek, a stream, and he actually had a working gold mine in his basement. The previous owner dug down and found a gold deposit, small vein, nothing exciting, but this barber of mine owned a barber shop, but he mined gold in the weekends in his basement. It's so cool. It'd be so neat to be involved in something like that.
Well, I've heard of the book, The Wealthy Barber. Maybe he was yours. Should people put their hopes in little deposits like that if they're going to invest in small mines?
No, I don't think so. The exploration game is so risky. There's literally hundreds and hundreds of gold and silver explorers listed, mostly in Canada. That's kind of the epicenter of global listings for small mineral exploration companies, and the great majority of them are going to fail, Jim. It's so hard to raise the cash and to keep investors interested long enough to act first to find a deposit, then spend the 15 years it takes to get your deposit from, deposit stage into a producing gold mine or silver mine. Most of that is permitting, of course. The governments make it really hard to start a new mine. And so I personally prefer established miners. They can be small miners. I mean, they can produce, say under 100,000 ounces of gold, under a couple million ounces of silver a year. But once they're established miners, you have a much better idea of what kind of cash flow they can generate going forward. And so we have invested a lot in pure explorers over the years, but we tend to only do it if they have really exceptional projects like world-class projects, world-class deposits. For the most part, though, I avoid the companies that are just looking for, just kind of piddling amounts of ounces, because it's so hard to cash flow and it's so hard to get capital from investors. Banks won't loan them money ever, so they have to convince investors to throw money at them for years and years and years for there'll be any return. So I prefer established miners for a lot of reasons. Much safer.
We're speaking with Adam Hamilton, CEO of ZealLLC.com from Colorado. Adam, gold and silver traditionally had a ratio of something like 50-1, talking about the price. It went to 80-1. Is that gap closing at all?
It is starting to close, Jim, and that's been an incredible opportunity. I've been writing about that when it was really low. For instance, in the first quarter of 2016, the silver-gold ratio averaged about 79.5, so there's your 80, and went even lower. And if you look back in modern history, the only time that ever happened before was during 2008 stock panic. Obviously, the stock markets plummeted. The S&P 500 was down like 30% plus in a single month. Gold and silver got sucked into that panic selling, mainly because the U.S. dollar was bid up aggressively during that, and that caused future speculators to just run from gold and silver. But anyway, silver fell much farther than gold back in 2008, and it also hit these similar levels relative to gold, around 80 times. It took about 80 ounces of silver to equal the value of 1 ounce of gold. But if you look at the pre-panic average, it was around 55. That was between, say, 2005 and August 2008. If you look at the post-panic average from 2009 to 2012, that was around 57. So I think you can call it around 55 in modern times in the past decade plus. And that's really exciting for silver investors, because if you take 1250 gold and divide it by 55, just a normal long-term average, you get around $23 silver. And I think that's a piece of cake. The $23 silver should be nothing. We should be able to easily hit that. And the cool thing about mean reversions is once you have a particular price extreme, like silver falling too far relative to gold, it tends to overshoot dramatically in the opposite direction. So we're likely to see the silver-gold ratio go way, way lower. Silver's worth more than gold. You have to invert that scale. It's kind of weird to talk about, but way lower than just the average. For instance, back in early 2011, coming out of that late 2008 stock panic extreme, the SGR shot as high as, say, like 32, 33. And that puts silver, that's when silver hit $48 an ounce. And so we're going to see an overshoot after this extreme as well. This early 2016 extreme was one of the worst in all of history. And so the mean reversion potential of silver is really awesome. I'm really excited about that.
Are people really stuck on just silver or gold, or do they mix those investments?
It's a great question. I've been in the newsletter business for 16 years, so I talk to people all the time. Every day I get emails. I talk to people. I meet people who are interested in the kind of contrarian investing we do. And I find that most people are pretty agnostic about gold and silver, Jim, in my experience. They like gold. They like silver. They realize silver has more potential than gold, yet it's riskier. That being said, there are some people who silver's kind of like religion. I don't say that negatively at all. Just silver's their thing. They love silver. They're all about silver. All they care about is silver. And good for them. That's awesome. But most people generally don't pick between the two, don't care too much. One of the problems with pure silver investors is there really aren't that many silver miners to pick from. The industry is small. As we talked about earlier, there's not that many pure silver mines in the world. Even most of the silver miners today, the prominent names that your listeners would recognize, like say Tahoe Resources, they get most of their revenues from gold. It's kind of crazy. And so most of the companies that people consider primary silver miners today are actually primary gold miners. If you take the amount of their revenues, their sales that come from gold versus silver, gold is worth so much more than silver. A lot of silver companies over the past couple of years have actually diversified by buying primary gold mines. The reason being they want more cash flow. The economics of gold mining are much more favorable, especially in the past couple of years during the dark times when gold and silver were in these deep secular bears. And so it's really hard to find pure silver miners, and that makes mixing gold and silver investment much more viable than just taking a pure silver approach, despite silver having a higher upside potential ultimately. If you're just into the metals, one of my favorite newsletter guys who's been in the business for decades, his name is Franklin Sanders, and he doesn't like stocks for a variety of reasons, but he buys gold and silver, and he looks at the silver-gold ratio as the key. When silver's too cheap relative to gold, he buys silver. When silver's too expensive relative to gold, he sells silver, and vice versa. So he trades silver versus gold, and he's just made a ton of money, trading these trends like that. So you can just invest in the metals if you want. I prefer stocks because the upside's so much higher. But yeah, so most people don't really have a preference over gold and silver in my experience.
I was just going to ask, should people be investing in bullion or investing in the miners? I know with the miners, with low prices over the last few years, they've become incredibly efficient at producing what they do. So would that make them even brighter as an investment?
Oh, absolutely. Absolutely. I think everybody should have a core foundation in their portfolio of physical gold, physical silver. I think that's really important for a variety of reasons. And I think it should be in their own possession, that first 5% to 10% of your investable assets. Things can happen. Our markets are all computer, dominated. They're fragile. Things can happen. Flash crashes can happen. Governments can close. Governments can fall. Institutions can fail. Banks can fail. Exchanges can fail. I've always thought it was wise to have some physical bullion, 5 or 10% of your assets in your own physical possession before you start investing in anything else. After you have that position laid in, you can go into the gold or silver ETFs if you want. You can go into more physical bullion, or you can go into gold and silver stocks. Personally, I prefer that, Jim. The upside in these companies is just mind-boggling. For instance, we always do trades to our newsletters for our subscribers. We do them. We recommend them to our subscribers. We bought aggressively in the past 6 months or so. Like even when everybody hated, gold and silver stocks back in November and December, we have multiple trades that have more than tripled since then, 200% plus gains. We have one silver stock that's more than quadrupled since January, 3 months quadrupling. And silver's up 24, 25%. So when you get 300% gains out of 20% moves in silver, which admittedly is extreme, but I mean, gold stocks in general, as measured by the Hewlett, are up 130% from their early January low, compared to 20, 25% in gold or silver. So I've always liked the upside leverage inherent in gold and silver stocks. And to your question about efficiency, that's a great point as well. We've done a lot of research in that at Zeal. We take the leading gold and silver stock ETFs, GDX and SIL, and then we look at all the companies. We go through their 10Qs or 10Ks, their quarterly filings with the SEC. We look at what their cost structures is. What are their cash costs per ounce? What are their all-in sustaining costs, which includes everything it needs to maintain and replenish current production levels? What's their cash in hand? What's their operating cash flow? All this stuff. And I was really interested in the fourth quarter of 2015. That was the worst quarter for gold and silver, and I remember the exact number, 5, 6, 7 years. Silver averaged around 1475. I think gold was just over 1100. Worst quarter for these metals in many, many years anyway, 5+ years. And the all-in sustaining costs of these leading gold and silver miners are amazing. The gold miners had average all-in sustaining costs in the fourth quarter, say around $850 per ounce, Jim. And the lowest gold got was $1,050. These are rough numbers. I don't have the exact spreadsheets in front of me. But so the gold miners never faced an existential threat in Q4 2015, despite what people widely thought. And the silver miners were the same. Silver, once again, averaged just under 1475, if memory serves, and the all-in sustaining costs were actually average all-in sustaining costs for the elite silver miners of SIL, the leading silver stock ETF, was just over 13. So these companies never faced any problem at all on the cash flow front. They were making plenty of money. Their operating cash flows were high. Their treasuries were growing. They were doing great in these environments. And so I think it's really important to look at the cost structure. There was absolutely no reason that gold and silver stocks were trading at fundamentally absurd 13.5-year secular lows in late January. It was ridiculous. And if you look at the cost structure, you can kind of get around some of the emotion involved in gold and silver stock trading and see if these companies are actually viable and see if the current pricing environment is actually a threat to them or not. It's fascinating stuff.
And also with lower costs, lower energy has helped them as well, hasn't it?
Yeah, on gold and silver mine costs, the costs are essentially fixed in the mine build. When you build a new mine, you have engineers figure out what the deposit's like, and you figure out how you're going to mine it. That determines how much waste rock you're going to remove and what kind of processing infrastructure you're going to build around the deposit. And so most of the costs are essentially fixed in the mine build in the construction phase. But among the variable costs, fuel, energy is the largest cost. Diesel fuel, electricity, and so low oil prices are a huge boon for the gold and silver producers. And the World Gold Council has actually talked about that in their Q4 report, Gold Demand Trends. Q1 isn't out yet as of this week, but it's coming out, should be out next week. But anyway, the World Gold Council in Q4 said that they don't suspect all-in sustaining costs to fall much farther because unless oil costs keep falling, which is really unlikely, when oil was down in its mid-20s when the World Gold Council published this Q4 report, they're going to have a hard time squeezing more cost savings, the gold and silver miners, out of energy prices. But nevertheless, all-in sustaining costs were way, way, way below the secular lows in gold and silver, which is really encouraging. These companies were doing great even in Q4 15. And if they were doing great then, it's no wonder they're up 100, 200, 300% since then because their cash flows are so high as gold and silver mean revert higher.
Was it surprising the price of gold stayed as low as it was for such a long time, considering the demand put on it physically by China, Russia, and India?
It was absolutely ridiculous. The fundamentals obviously didn't argue for such a crazy low gold price for so long. It was really frustrating to those of us investing or interested in this sector, the people in the mining industry. You've talked to people. I have many friends who lost jobs in the mining industry. It's been horrible in the past couple of years. And the whole thing was fake. It was artificial. It was based on stock markets levitating because the U.S. Federal Reserve back in late 2012 implemented a new quantitative easing campaign that was unlike any it had done before. QE3 was unique in that it was open-ended. So the Fed didn't say up front, like in QE1 and QE2, how many treasuries they're going to monetize, how much money they're going to spend per month printing money to buy treasuries and mortgage-backed securities. Instead, they said, or how much they're going to in total, Instead, they said, we're going to do this much per month, and if we need to, we'll increase this. And so every time the stock market started selling off in early 2013, the Fed officials just come out and say, hey, we're ready to ramp up our QE3 if necessary. We'll print more money. We'll buy more bonds. And so traders came to believe that the Fed was effectively backstopping the U.S. stock markets. And as the U.S. stock markets go, the world stock markets go. So this whole thing started a levitation in the stock markets 2013, 2014, into early 2015. And as the stock markets did nothing but rise far beyond anything that was fundamentally, technically, or sentimentally righteous or even remotely justified based in history, people decided they didn't need alternative investments. If the central bank's going to prop up stock markets, why do we need gold? Why do we need something that moves contrary to stock-heavy portfolios? And so everything that happened between 2013 and 2015 in the markets is a central bank conjured fiction. And so gold and silver should never have been that low. If stock market cycles would have acted normally, gold and silver would have been much higher. Jim, I think back in 2012, the year before QE3 ramped up to full steam, gold averaged just under $16.75, and silver was around $31 an ounce. And so the mean reversion, my high probability for success, very conservative mean reversion targets are those 2012 averages. 16.75-ish for gold, 31 plus for silver. Those should be a shoo-in without even any overshoots. So it was a total anomaly what happened in recent years.
We're speaking with Adam Hamilton, CEO of ZealLLC.com in Colorado. Adam, how big of a factor is manipulation in the prices of gold and silver, or are they just built in because they've been going on for so long?
That's a great question, Jim. Back in my early days of writing publicly and analyzing this stuff, I tended to discount the manipulation theories and got a lot of hostile feedback because of that. This was back in 2000, 2001, 2002. But as the years gone on and I've started to understand how futures trading works and how the price fixing works and stuff, I'm starting to take more stock in these theories. Just in the last couple of weeks, I saw an article about Deutsche Bank, a major player in the gold market, apparently admitting that it had been involved in manipulations of the gold price. I don't know if this is material or how far back it runs. The case hasn't been filed as far as I know yet, but there's definitely manipulation. There's people who have a strong interest in not seeing gold and silver rise. I suspect it goes back to central banks. Gold rising is kind of like a vote of no confidence in a national currency. And all central banks can do is print money. That's their only tool they have. Liquidity and Blarney is how the newsletter writer Franklin Sanders I mentioned earlier describes it. They can print money or they can talk about printing money, and that's it. So if gold rises too high, the people tend to perceive that, hey, we're having this inflation here. Our central bank's debasing our currency. So there's a vested interest in not having gold or silver get out of hand. And so there's definitely manipulation there. I think free markets easily trumps manipulation. When investors are coming back in a massive way, it doesn't matter what central banks or their proxies or commercial banks are doing. Case in point, gold got down to around, 250, 255 back in April 2001 or so, and went up to 1900. If the manipulators really had significant power, gold would have never done that. It would have stayed, under 300, under 400. But the last huge bull market in gold and silver proves that the manipulators can't control them if investors are buying aggressively. And so manipulation is definitely out there, and I'm becoming more and more aware of that as more revelations come out. But it's a side effect. It's just a trivial thing compared to investment buying. As long as investment buying is strong, doesn't matter what people want silver to do. The cash coming in is going to bid it higher.
Yes, on the show we've had several discussions about the viability or the fairness of central banks, and basically they believe that they run things and that they can control. And yet, since central banks were created, we've had something like 19 recessions. So how good are they at running the economy? They're terrible.
As your listeners well know, there's this huge wildfire up near Fort McMurray. Just a tragic thing. Just horrible. And I think of markets kind of like forests. If you have a market, you're supposed to have normal cycles. You have bulls and bears, and the purpose of the bears is to let markets go sideways long enough for valuations, for earnings to catch up with high stock prices. And bulls, stocks get bid too high, and bears allow earnings to catch up with stock prices. Things will get out of hand. The bankruptcies in bear markets are important. They clean out the deadwood. So I think of markets like forests. When firefighters go out and suppress every little fire, which I understand why it has to happen, good for them, but all of a sudden you get all this undergrowth that accumulates for years, decades, and then all of a sudden there's some spark and you get this huge wildfire conflagration, and you would have smaller fires more often as opposed to one massive fire that destroys everything every 50 years or whatever. And so I think that's what central banks do. They're in fire suppression as far as markets go. They try to stop bear markets. They try to slow normal corrections. They try to stop bankruptcies. But the problem is all that deadwood and underbrush just builds up, and eventually a spark hits it, and then the central banks are powerless to control the result.
Someone said to me, we should let all these companies fail, and if those companies are big banks, they should fail.
I agree 100%. I've always said that. It's a really unpopular opinion, But yeah, if businesses are too aggressive, if they're mismanaging their risks, if they can't survive, if they can't earn profits doing what they do, they should fail. That's the way it works. That would make room for new, smaller, more nimble, smarter competitors. Maybe the big banks should have failed. Maybe General Motors should have failed back in 2008. Make room for newer competitors. So I've always thought that. Even governments, if people get too far into debt, mismanage their finances too much, they should fail. They should be penalized for their bad decisions and let new players come in who are better at managing money and resources.
Well, Britain's just passed a law that would send bank CEOs to prison if they allow their banks to fail, because they said the signs are so obvious. How can you let that happen?
Interesting. Yeah, banks are weird. They're kind of a black box. Like there's so many things that go into those financial statements. I happen to be a CPA. I was an auditor before I got into the newsletter business and professional trading, and I tried to read those 10Ks and 10Qs from banks, and I just can't understand them, Jim. I have no idea what's going on. And I look at their quarterly reports because Wall Street follows them. They move markets. And all they do is they make up these plug numbers. Like, for instance, they have a loan loss reserves. I think they're going to lose X amount of money due to bad loans. And if they're short in earnings, they pull down those loan loss reserves. If they have surplus earnings, they add to them. Everything's manipulated in the banking industry. And I agree. The CEO should have more responsibility. I don't know how they know what's going on in their banks. It's so cryptic to me anyway.
You had some ideas about the Bank of Japan going to negative interest rates. Folks there apparently took their cash out of the banks, bought home safes, and now they're keeping their money at home rather than putting them in a bank where they lose money. At least at home you'll have it. Any thoughts on the Bank of Japan and what it's been doing?
Yeah, the Bank of Japan is just crazy. I mean, I don't use that word lightly, but they're like the most extreme of all the major world central banks, and it's just incredible. I think it was January 29th when they went to negative interest rate policy, NIRP. And the main reason the Bank of Japan's Haruhiko Kuroda went to negative interest rates, that's the governor, the guy who runs it, is he wanted to weaken the yen to help Japanese exporters. Japan's a heavy export-dominated economy. He also wanted to boost the stock markets because there's a huge wealth effect in economies. The higher the stock markets are, the better people feel politically. He was appointed by Shinzo Abe's, is it the Liberal Democratic Party, Jim, the ruling party in Japan?
That's been there forever.
Yep. And so, but NERP was a colossal failure. Like, as of last week, I think the yen was up almost 10%, like up against the US dollar since the day before, the Bank of Japan went NERP in January 29th. And, the Japanese stock markets are down hugely. I don't know the exact number, but it might be 10, 15, even 20%. Like, the markets have done just the opposite of what all central bank theory, all Keynesian theory said would happen. And last week it was pretty interesting, Jim. The Bank of Japan had a big meeting, and there was a lot of talk from official Japanese government circles leading into that meeting that the Bank of Japan would have to do something. There were several conjectures of what it would do, but it would do something. For instance, it might up its stock ETF buying. Apparently the Bank of Japan is now a top 10 owner in 90% of the Nikkei 225 stocks. That's the 225 companies that make up Japan's equivalent in the S&P 500. Bank of Japan, top 10 owner, 90%. Crazy. And then another thing it could have done is gone deeper into negative rates for its deposit rates. But there was also talk that the Bank of Japan would implement NERP on the lending side, which means when Japanese commercial banks went to the Bank of Japan to borrow money, the central bank would actually pay the commercial banks to borrow money. So anyway, last week there were all these expectations built in about what would happen, what the Bank of Japan would do. And shockingly, the Bank of Japan shocked the world. I didn't know it could do it anymore. It did absolutely nothing. And this was April 28th, I believe, and the whole world was just shocked. The yen just rocketed against the U.S. dollar. I think it was up like 3.1%. That was like the biggest up day in, say, 5 or so years. But the really interesting thing for your listeners is gold and silver shot up that day too, because the strengthening yen from the Bank of Japan doing nothing weakened the dollar, and gold rocketed up, I don't know, 1.7% that day, 2% plus on the next day, which was a Friday last week. Silver was up 2% and 1.5%-ish. And so both gold and silver made major new bull market highs thanks to the Bank of Japan doing nothing and, boosting the yen and weakening the dollar. It was really fascinating how those central bank decisions from faraway countries just ripple through the whole global markets to have such vast impacts. It's just fascinating.
In Japan, in Hong Kong, other places in Asia, they have vending machines that will sell you a thin wafer of gold. Do you ever see that happening in North America?
I don't know. You know, the Asian cultures have a deep cultural affinity for gold. They've always liked gold. You know, China, Japan, India, they understand its value for preserving wealth. And in the West, you know, it seems like we've gotten away from that. You know, we have all our paper assets and we think they're stable, and, you know, we put most of our wealth in real estate, which is not something that's as common in Asia. And so I really think there should be an easy way in the West for people to buy physical gold and silver bullion, and I hope there is. But without that cultural affinity, Jim, it'd be harder for some kind of startup or some kind of bank to do that and succeed. But hopefully we'll get to the point after gold and silver rally for enough years, after the stock markets, you know, fall long enough, people want to buy gold and silver, and there'll be demand for that kind of thing.
Adam, do you see any kind of cycle or wave here with gold and silver? Some people have told me they expect it to be strong, then of course a correction, but by the end of the year it will really be climbing.
Yeah, absolutely. I think that's a great bet. One of the things I've studied over the years is seasonality, and actually spring is a strong time for gold, silver, and the gold and silver stocks. But summer is the weakest time of the year. Summer is the only time of the year where there's no major gold demand spikes worldwide, like anomalous demand. Like for instance, August has like Asian harvest, September, October, Indian wedding season, November, December, Western Christmas buying, early February, late January, Chinese New Year buying. But anyway, June, July are the only months of the year that have no big outsized global demand spikes for gold. So gold and silver always tend to slump in what I call the summer doldrums. So I totally think that it's probable we'll see, you know, gold and silver in their stocks do pretty well in May. But after that, we'll probably see a drift lower this summer. So I think your listeners should look to pick up positions that they don't have yet, maybe late July, early August. That's when the seasonal is bottom. And we should have a strong rally into the end of the year, especially if the stock markets continue in their bear market trend. You know, we almost lost that bear market in the stock markets a couple weeks ago. And I'm talking U.S. S&P 500 basis. I think the S&P 500 back in late April was like 1.5% away from its all-time record high from May 2015. And that would reset what I believe is a cyclical bear back to zero, but it didn't. And so we're due for another big sell-off in the stock markets. And that'll, of course, boost gold demand, just as we talked about at the beginning of the show, how investors don't look for alternative assets until their primary assets aren't doing well.
Adam, how can people find out more about ZealLLC.com?
Well, just come to our website. As you said, it's ZealLLC.com. Every Friday I publish a free essay talking about something, digging deep with charts and historical analysis. We publish a couple of acclaimed newsletters, a monthly and weekly for investors and speculators. Cost is just around $10 an issue, so pretty affordable for everyone. If you're interested in contrarian investing, I think you'd love our stuff.
Adam, thank you so much for chatting with us.
Thanks so much, Jim. Great to see you. Have a great day.
My guest has been Adam Hamilton, CEO of ZealLLC.com. He was speaking to us from Colorado. That wraps up our show for this week. We'd like to thank our guests, Ross Clark and Adam Hamilton, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. Happy Mother's Day. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.